And we're saying right now, the technicals for massive breakage in the stock market are literally single-digit percents below, especially when we get into next quarter. And all you got to do is the rest of this quarter, the remaining 3 weeks, is to see a minor wobble, and we're with the nooses around the neck. And it's at that point, then suddenly all the data metrics that the Fed likes to hang their hat on, they'll panic. And therefore go what? Monetary expansion, all the panic methods they use. And that will benefit primarily what? The monetary metals.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for December 3rd through December 10th, 2024 while supplies last. Right now we have 1 ounce silver backdated South African Krugerrand at just $3.19 over spot per ounce. We also feature the limited edition 2024 1 ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. And finally, 1/10 ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be here, Elijah.
Well, it's great to have you today. I did want to touch on the precious metal markets as we're seeing. It seems like a pretty good recovery here. But first, the headline of today, $100,000 Bitcoin, your take on what we've seen here.
I don't trust the Bitcoin move. I think it is highly correlated to NASDAQ 100. I think it is a bubble. And we have technical reasons to distrust this surge that went through 73,000. Oh, it's joyous. There's no question, But the sustainability of it is highly suspicious from our macro technical point of view. So we're doubters, okay? Not negative right now. We've got some levels below that will turn us negative, but I'm highly suspicious that it is, to a large extent, reflective of NASDAQ 100.
Now, what kind of indications would you look for a confirmation that this move is sustainable or that we could be seeing a significant pullback from here?
It's almost impossible, frankly. Our long-term momentum of quarterly momentum of Bitcoin is in a position where if you keep going up, it's not going to confirm. You'd have to literally leave the earth to confirm it. And I don't think it will. Too many other the more intermediate metrics that we look at, intermediate trends, say, no, you're overbought, you're going to wobble, and you can't afford to wobble. This is a headline event. I like to link it to the tulip bulb mania. Okay, it is highly correlated to the other bubble out there, which is primarily it's U.S. stock market, but mainly the NASDAQ 100, which has been the leader index all the way up. And more than doubled what the S&P did since 2009. And it will lead the downside. And they're both, of course, beating their chest right now, especially post-election. And so I guess you buy the news, right? Okay, we shall see. I'm highly suspicious that by the end of this month, we will have a wobble, especially in the stock market. I think Bitcoin will likely reflect that. I don't mean a collapse, a wobble, a subtle wobble. Let's call it 4% or so off where you are right now. There's a problem with that. I'm talking NASDAQ and S&P right now. If you have that kind of wobble, that doesn't do any damage to the price charts. But our quarterly momentum is very eerie. In other words, when we look at the momentum of the S&P and the NASDAQ 100, yeah, you see the price doing this upward curvature thing. But when you look at momentum, you see a floor that's been used and used and used. In fact, there's two floors on each. There's the upper floor and the second floor, but they're very close together. So it's like two sticks of dynamite. You drop back and close this month with a wobble. I don't mean, doesn't have to close down on the month. Just close back for example, I'll give you my best guesstimate. 5,800 on the S&P. It's only a couple hundred points below you right now. That's still up on the month, for example. NASDAQ 100, it's 20,700 is kind of my projected monthly close. That is, if we wobble just a teeny bit next week, I think you're going to probably see further oozing back by those indices. The problem then is, as soon as you open the next quarter, you're in a very dangerous position on quarterly momentum. The kind of structure that if everybody was listening could see the charts that we issue and see the momentum structures, they would say, ooh, that's eerie. You don't want to go there. So anyway, I think we're setting up for that. Now, that also will have major wave effects on the monetary metals.
Now, getting into the monetary metals, I know we've seen a significant pullback since the election. However, it seems like we're seeing pretty good stability over the last couple of weeks. Gold really holding up around 2,600. Silver, popping back above the $31 level. But your take on where we are there?
Yeah. Well, if you just look at if you bought the news, S&P, NASDAQ, like November the 6th, the day after the election, you had a massive upsurge. And November 5th and 6th, excuse me. The 2 days right after, you had this massive gap up type surge. And the metals, monetary metals, did quite the opposite. They collapsed. Silver and gold are trading now back above the price level they were when people sold the news. So if you sold the news of the election, Trump's going to defeat inflation, all this, you're losing right now. Silver and gold are actually back above those levels. S&P and NASDAQ are above the levels where if you bought the news, you're still making some money. Not a lot, but you're making some money. But it's interesting, the monetary metals have regained that loss and are trading higher than they were post the election. I think what's restraining, we still anticipate the monetary metals will have a vertical phase. And you remember the monetary metals took off back in March. We beat the table. We said they're going to accelerate up out of this 3-year wide range. And at that point, silver was trading between $25 and $26. And gold was just above 2,000 yet again. It had been above it a couple times before. But this time it's different, we said. We're going to take off. And they did take off. I mean, gold's no longer 2,000. It's 2,650 area, trading right now as we speak on the front month contract. And silver's trading 3,160. Back then it was 25.26. And it's actually up more on the year, marginally right now, because the S&P's gained some of the last, since the election, and NASDAQ has. And gold and silver have cooled off. But they're still actually up year to date more than the S&P and the NASDAQ, which nobody realizes. They think it's, they got to be beaten, but they're not. They're actually up more than the S&P and the NASDAQ. And we suspect the key ingredient now to engage the silver and gold into a stronger upside is to break the stock market. I don't mean you have to crash it. Start to get the blood flow out of the stock market. Where the assets start to get nervous, they move elsewhere. And there's no time in history where when a stock market collapses, everything else goes down too. There's always some other place they go. And history has told us, 2000 to 2002, 2007 through 2011, gold went up with a break in 2008, but basically rose while the stock market went down. Same as the dot-com tops. Gold went up during that time. So did T-bonds. It was contra. It was a place to go. And if you'll notice in the recent 2 weeks, the T-bonds, which have lagged gold in terms of being an upside alternative, they've been under pressure. They turned up sharply. So somebody's buying T-bonds now. And it's not related at all to the Fed, because if you look when the Fed cut rates in September, T-bond prices went down, yields went up. So it didn't matter what the Fed did, the short end. But suddenly for the last 2 weeks, some asset managers have been buying T-bonds. Why? Are they nervous? Are they starting to vacate their stock positions? If we see any wobble in the stock market, I think you're going to see the monetary metals gain from that blood flow. And the next quarter could be very dramatic.
So it really does seem like upward from here for metals, and that this pullback is kind of maybe a fake out in your view?
It's another one of those pauses where, remember, between 2020 and 2020, early 24, you had this up down in gold. in a range. And you had silver in the staircase to the downside, overlapping, it would go down and go halfway back up, et cetera, et cetera. That tone has totally changed. Now it's all upside, but with pullbacks. So for silver, it's like 3 steps up, 2 steps back. For gold, it's like 1 step up or 2 steps up, 1 step back. Silver is always more erratic, okay? It gets punished more in the pullbacks than gold does, and then on the upside, it gains more. But even that type of behavior, which is different from the prior 3 years, it's a positive direction at least, even despite the pullbacks. I think it's going to accelerate to where you go up 5 steps and then pull back 1, not 2 steps, okay? And I think that tonal change will occur once asset flows start to leave the stock market bubble. And therefore, our focus right now is primarily on the S&P and the NASDAQ 100.
So the interest in the bond market is kind of interesting. I did want to ask you then, how does that play into possibly the bank stocks?
Well, in our last weekend report, we updated XLF, which includes bank stocks and also asset managers and insurance companies. And so it's the financial ETF, broad financial sector. And it's getting hit this week. Now, NASDAQ's up, S&P's up. The financials are down, and frankly, they're trading right now with a couple hours to go in the week below their a level that we didn't want. If you close below it, it isn't a good sign. Okay, so despite the chest beating by certain narrow sectors within the market, particularly tech this time, Nvidia's popped back up again, not to its highs. It's still well off its high recently made. But you've had enough of a bounce to where NASDAQ is leading the charge this week. But look at the other sectors. Look at commercial real estate, RWR. It's a very vulnerable sector financially. Look at XLF. Why are they down? Why are T-bonds up? Anyway, you got to watch these things because these are the factors that ultimately will play in an enormous way. The debt problem is not going to go away. I'm talking the commercial debt primarily here.
You're mentioning how it seems like there are a lot of funny actions in the market where it maybe is the calm before the storm would be that might be your view?
I think it's a bubble. I think it's the bubble, it's the headline chasing bubble. And I know there's a lot of positive assumptions about what Trump might do or can do, but or might like to do, we'll put it that way. And the people, some of the people around him, not all. Okay, you scrutinize down the list of some of his appointees, you don't quite get this total free market thing or total change view. And now with Elon Musk and Vivek Ramaswamy, that's different. They're headed in the right direction. The problem is they can't simply dismantle this stuff. They can't just pull a plug and say, okay, it's over. They have to go to Congress to get approval on a lot of these things. It's going to be delayed. It's going to be fought. It's not going to be so easy as they think. And there's the other problem, and the problem would have existed no matter who got elected. We have a stock market bubble. It is the biggest stock market bubble in U.S. history. It's been going on since the 2009 low. And if you look at a money supply chart, you'll see why. Greater monetary growth in the last 10, 15 years than any other prior 10 or 15 years. And Fed funds rates during 10 of those 15 years have been at zero. So, they've been giving money away. So no wonder the market got fueled into a bubble. That bubble will break because it's created errors, embedded economic errors, micro errors by individuals, families, companies, macro errors by governments, etc. And when these errors get ripped open and exposed, they don't go away. And usually that occurs once the stock market breaks its technicals. And we're saying right now, the technicals for massive breakage in the stock market are literally single-digit percents below, especially when we get into next quarter. And all you got to do is the rest of this quarter, the remaining 3 weeks, is to see a minor wobble, and we're with the nooses around the neck. And it's at that point, then suddenly all the data metrics that the Fed likes to hang their hat on, they'll panic. And therefore go what? Monetary expansion, all the panic methods they use. And that will benefit primarily what? The monetary metals.
And again, we've talked about this before, but typically, as you mentioned, how the Fed has kept interest rates super low for so long over the past 2 decades, and how they have expanded the Fed balance sheet, that has benefited largely the stock market. And also monetary metals. Obviously, we've seen an increase in gold and silver. But this time, you think that this expansion of the balance sheet and bringing interest rates down will really primarily benefit not the stock market, but monetary metals.
It benefited the stock market in the dot-com bubble. Okay, you can look at the Fed funds rate chart then too. You'll see that they cut rates, and a bit lag to that, the market took off. And then they started raising rates during late in the rally. And when the market finally topped, they started cutting rates again to save the market before it actually had collapsed, before the 2000 dot-com became a collapsing instrument. It was by 2002 before you realized it was really in trouble. And 2007 did not get bloody until late 2008, but they started cutting rates at the top. Now, they've already started cutting rates because they sense something. They see something in the data. And as we know, Powell has said, okay, this inflation mandate, that's one thing. Well, we're focused on the jobs now. And he knows the job data is not good and is not getting better. So they've already shifted. But when you look back at their shifts that occurred at and shortly after those major tops, it did not stop the downturn. The money flow did not help at that point because they had already created the bubble that once it broke, reality took over and they couldn't stop it. Instead, that money flow that they created, the river flow, asset managers, instead of putting it into stocks, put it into alternatives. They bought T-bonds, they bought gold. And I think we're beginning to see that now. Already early this year, gold has exploded. Silver's exploded since earlier this year. And T-bonds are shooting back up again, as if somebody wants them for some reason. And they have been moving almost weekly opposite to the price direction of the S&P and the NASDAQ. T-bonds have. And now suddenly they just shot up very strongly this week especially. Why? If we start to see weakness next week in the stock market, we'll see, the inversion still exists. So the Fed can do that and it won't help. That's what I'm saying. Yeah.
Besides the renewed interest in the Treasury bond market, are you seeing any other signals from maybe the big players that, the stock market may be topping out here?
Yeah, well, we watch Nvidia, of course, because, it's the focal point for so many people. And even its price chart, if you look at it carefully, a weekly, go back and look at the last year or so of action, and you'll see what's developing could be head and shoulder top. I don't normally focus on that stuff because quite often those things generate false signals. But the problem this time is momentum fully agrees with that head and shoulder top. In fact, it suggests that high you saw, that spike we had in Nvidia price about 3 weeks ago or so, we got up to 152. Next thing you know, we're down to 132. Now we're back to 143, halfway between the two. You don't want to go back down to the low 130s again on Nvidia. You do. The price chart says you're in trouble. Momentum says you're in deeper trouble than even the price chart suggests. So even the leader symbol should be watched. And it's not making new highs right now. It's halfway between its spike high, newsy high, and its recent twice used level at 132. So you do not want to ooze back down again in that major symbol. And watch the financials too. Nobody's noting that this week. How come the financials are down? How come they're breaking below their weekly momentum structures? Anyway, so yeah, there's things to watch there that are individual symbols. And also in the commodity complex, their lag to gold. Commodity complex did not participate in the gold move in 2000 up to 2020 highs. In fact, commodities were under pressure between 2015 and 2020. Whereas gold was doubled in that time. And then when gold went sideways, commodities exploded late 2020 to 2022. So totally opposite gold. But they're now getting back in sync, I think. We're particularly watching the grains. They've been beat up real bad, but they've got major momentum basing patterns that suggest to us they're ready to turn up in a way that will hurt basic food stuff.
Sounds like more inflation than here to come. Before we let you go, can you give us kind of some price points or what to look out for in the metals markets?
Yeah, I think, you don't want to ever take silver anywhere back near the 35 level again. Let me put it that way. We get very specific with our subscribers, and I can't give it out for free, okay? But basically, don't ever go back to the highs again. Don't even approach them. Don't even go back to 34 again, okay? If you do, you're not going to stop this time. And we suggest strongly that if you get back up there again, and then you get gold back up within $50 of its high, you hit 2,800, you get back up in the mid 2,700s again. And I think we traded over 2,700 this week at some point. You get back up in the mid 2,700s, not even back to the 2,800 high. Don't count on the next advance being similar to the ones we've seen this year, meaning 2 steps forward for gold, 1 step back, 3 up for silver, 2 steps back. Expect something far more dramatic. And we bet that when that occurs, when silver and gold percolate back up toward those levels, the prior highs, that you're going to see the S&P oozing down toward what I mentioned a while ago, toward those levels aren't far below. And that is, I think, the key factor in igniting the metals into a more vertical phase.
And if our viewers are interested in learning more and subscribing to your newsletter, they can go to olivermsa.com. Can you tell us a bit about that?
Well, we look at all 4 major asset categories because especially now they are like icebergs bumping into each other. And some assist each other, coincident, like we think T-bonds will follow gold up for a while, by the way, not a long-term move. T-bonds could surge for, let's say, a quarter or so. But the stock market now, I think, is going to become inverse to gold and silver. And that's going to help gold and silver, not hurt gold and silver. So it's important to watch those. Also, the foreign exchange markets. We recently saw a surge in the dollar that popped through some price chart highs that people said, oh boy, a breakout. Immediately aborted back down. And we're now literally, when you get into next quarter, we got 3 weeks left in this quarter, dollar's trading 105.5. You frankly don't want to see it down to 104. You see that, you start getting in trouble. And the dollar could suddenly wake up in a downside way, and that becomes a factor again. So there's a lot of big stuff going on. You have to watch all 4 categories.
Fantastic. Well, we'll put a link in the description of this video to your newsletter there so people can check that out. Once again, thank you so much for your time, Michael. You have a fantastic weekend, and God bless.
Thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for December 3rd through December 10th, 2024, while supplies last. Right now, we have 1-ounce silver backdated South African Krugerrand at just $3.19 over spot per ounce. We also feature the limited edition 2024 1-ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. And finally, 1/10 ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.